Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. The S&P climbed on Tuesday in another volatile session as the market awaited clarity from President Trump regarding his tariff policy rollout. The Nasdaq also closed in the green despite weaker than expected economic data. We're going to dive into the rest of the day's market trends. Then oil prices dipped Tuesday amid concerns about the impact of tariffs on the global economy and fuel demand, but will they dip even further? We'll explore that. Plus, Hooters is preparing to file for bankruptcy. I'm going to speak with the CEO to find out what's next for that restaurant chain. Well, according to our next guest, oil will likely fall to the low $60 a barrel range, levels last seen in 2021. That's as markets remain oversupplied. Joining us now is Vikas Duvedi, Macquarie Group Global Energy Strategist. It is good to see you. So let's get into these forecasts. Vikas, you have clients. They're asking you, listen, where oil is today, where it is 12 months from now. What are you telling them?
Yeah, look. What we tell them is that there's no way to avoid the geopolitical events that are, hitting the market from every direction, whether it's, Venezuela and Iran and Russia oil potentially being taken off the market. Obviously, that would make things more bullish, or demand getting hit from a potential trade war. And if not a trade war, then just tariffs, hurting demand. So those items are all so big that they're dominating the discussions in oil. Where we think it is right now, look, we don't think it's that far off of fair value right this minute, given the uncertainties about some of the areas that could get their oil supply reduced or exports reduced in Russia's case. But we do think, to your initial comment, as time goes on this year and especially next year, we're just in a world of far too much oil supply. There's just no way to get around that unless OPEC cuts even more, right? And I don't think they want to cut more than they've already cut. I think they would, but not much.
So is it, Vikas, is it fair to say, because you write about and the kind of dynamics, you put it like this, it's a tug of war, you say, between sanctions and tariffs. Is that how investors should think of it?
Yeah. Look, depending on how big the tariffs end up becoming, they could materially hurt oil demand. They could reduce oil demand growth by 25 or even 50% of the roughly 1.2 million barrels a day that we expect to grow this year. So, obviously that would hurt prices in a meaningful way. But in a situation where a significant amount of Russian barrels are taken off the market and Iran as well, you could end up losing as much as 3 million barrels a day of demand. Of supply from just those two countries. Add in a little bit of Venezuela and you get over 3 million of supply loss. That would take the market up to extremely high levels. And I don't think that's something, the Trump administration wants to add on to all the economic uncertainty, they're dealing with right now.
Vikas, how about China? I'm curious how China plays into your outlook looking ahead, because there's folks who point out to, or, what they would describe as, potential green shoots for China's economy.
Yeah, look, we've been waiting for those, and we're not seeing them. A lot of our channel checks with, a lot of people in China that we know well in the petroleum industry, same thing. Like, we're not seeing those green shoots. We're not hearing about them. They may yet arrive, right? The latest stimulus effort is aggressive. It just has to translate into petroleum demand for what we care about, right? And there's a chance that they get better economic activity, but it doesn't translate to petroleum activity. I'll give you an example. One quirky thing is they have effectively their own cash for clunkers program in the stimulus, but that would accelerate the adoption of electric vehicles. You turn in your old combustion engine car and you have a lot of incentives to buy an EV. So in that regard, the stimulus would actually hurt demand. So these are the kind of things that could be negative surprises, even though broadly, the stimulus could be beneficial for China's economy.
Let's talk geopolitics for a second too, Vikas. I'm just curious. Let's say there is a deal brokered between Ukraine and Russia, Vikas. Let's say you get a ceasefire signed. What would that mean for your outlook?
I think it would probably erase anywhere from $3 to $4 of risk premium that's in the price of oil as a result of the potential of a supply hit. And after that, I think it would start to get even more bearish because the Russian oil would, I think a lot of the sanctions, the price caps, things that are frictionally reducing its availability would go down, and the market could transact and have access to Russian oil more freely. And then the second step is they could probably start growing their production again. They're down about 500,000 a day, and they could probably get that back, especially if Western technology is allowed to work in the Russian oil sector again, as a function of a ceasefire with some visibility on ending the war, right? Not just a temporary ceasefire.
And a final question, Vikas, just top of mind, another geopolitical one. President Trump, Vikas, when he talks Iran, he does talk tough. Even this week, his comments on social media. I'm curious, just as an oil analyst, you see those comments. How do you think about that dynamic?
Yeah, we take it seriously. We've noticed the market isn't taking the Russian sanctions as seriously as maybe they should. Even though we're bearish, we don't want to ignore that as a risk to the upside. I do think the Iranian, our rhetoric and our positioning should be taken very seriously. Like there's a chance that this overflows into an escalated military situation. And then we think there's no way oil can't rally, right? That's just too much oil that's produced and exported by Iran, or that could be in harm's way logistically, right? From blockades, vessels getting hit, that type of thing would be factored into the price of oil very quickly. If the military escalation ends up matching what I think is the current rhetoric, to the point of your question.
A lot of moving parts. Vikas, thanks so much for your time today. Appreciate it.
All right. Thank you for having me.
Stick around. Much more Ask for a Trend right on the other side. The S&P 500 and NASDAQ jumped in a volatile session ahead of Trump's tariff rollout. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Thank you, Josh. We are starting with a bear trap, and that's actually a good thing for bulls. You don't want to be caught in a bear trap there if you are a bear. But let's look at the price action over the last 2 days. This is something that has kind of evolved over these 2 days in the major indices. You can look at the NASDAQ, not quite the Dow, but the Russell 2000 as well. So here's what we're looking at. Year-to-date chart of the S&P 500 price action. Yesterday, we just barely dipped below. In fact, we opened below to the lows of the year, new lows of the year, and then we closed in the green, and then we were able to close even higher today. Now, typically in a bear trap, you see the bears get caught and they have to reverse, they have to get out, and that provides fuel for the bulls. So that's kind of a short covering rally. Now, I'd like to see a little bit more green here in some of these candles. You want to see a little bit more continuation to the upside, but that is what that's what we're seeing here.
And for a bear trap, for traders playing along at home here, how reliably bullish is that, Jared?
For this particular scenario where we dip to a new 6-month low and then we rally and we close above 0.25%, it's actually not that great. And I was a little bit surprised. Jason Geffert ran the stats, found this on X, and it's not really bullish until you start looking 6 to 12 months out. But guess what? Almost everything in stocks is bullish 6 to 12 months out because stocks tend to go up. So unfortunately, history isn't that as favorable as I thought it would be here.
All right, Blickery point number 2.
Facts or feelings? We got a bunch of hard and soft data out today. I'll start with the soft, and that's a survey, ISM Manufacturing Survey. It was not that great. The median estimate was 49.5, came in below that at 49. New orders fell, production fell, employment fell. What rose? Prices paid. So that just kind of speaks to inflation. And then we also got the JOLTS report. JOLTS wasn't great either, but that is a hard data, and it's also covering February, which is a little bit more in the rearview mirror. The ISM survey I was talking about, that is March. But I did have a chance to sit down with Jessica Inskip she's Director of Research at stockbrokers.com. We have a brand new Stocks in Translation episode out today with her. Encourage everybody to look at it. And guess what? She was talking about hard versus soft data. Here's what she had to say.
We're feeling uncertain about the market, therefore consumer sentiment is down. You see this process of savings. The real answer is, does that translate into hard data? Do consumers stop spending? Do retail sales go down? Are earnings going down? That's the difference between soft data and hard data. And because of the uncertainty right now we have within the market, that creates volatility. There's lots of moves because we don't know what's going to happen. And that scares investors.
So soft data, weak soft data, doesn't always translate into soft hard data, but we're seeing a little bit of that, and that's a trend that we have to continue to monitor.
All right, so we've been looking backwards, which is important. History is important. Let's look forwards. What's ahead of us, Jeremy?
I'll tell you what, April is no joke, and let's take a look at some seasonality, because March was mixed, and we expected some turbulence in March. We got a bit more than what was expected, but here I have two models. I've been tracking these for several months now. The white one is my 1928 model, goes all the way back then. You got to match up the days of the week. And the green one is a median since 1990. They both target about 3% returns for the month, and they both take a pretty similar path. And you can see the white line here kind of stalls out after an initial punch up, stalls out in the middle, and then it accelerates into the end there. And the green is just kind of a little bit more steady there. And I also like to take a look at the VIX, which is kind of opposite equities. This is the entire year, and we've seen the VIX really trace out in green here. This is what actually happened, what was expected to happen in white. And you'll notice that white line is supposed to keep coming down. That means the fear in the market is supposed to be coming down, so that's bullish for equities. I will say April is supposed to be the most positive months of the year. If we can't manage green in April, we have a serious problem, and it doesn't speak well for the rest of the year.
Well, what else is on the calendar for April?
I got a couple birthdays in my family.
Do you?
That's about it.
All right, it's a big month for the Blickers.
Yes, it is.
Thank you, my friend. Great to see you. Stick around. Much more Ask for a Trend right on the other side. Restaurant chain Hooters of America filing for bankruptcy. That move coming to enable a founder-led buyout of the casual dining chain. Joining me now is Hooters of America CEO Sal Malili. Sal, it is good to see you. So you filed for bankruptcy today, Sal. Listen, being in the restaurant space, a lot of challenges, not easy, especially right now. Inflation and labor costs, Sal, an American consumer that seems to be feeling more cautious. But walk us through what happened here.
Yeah. Thanks, Josh. Appreciate you having me on today. And you're exactly right? The macro economy, the casual dining sector has been under a lot of pressure, right? The last several years, inflation, the food cost challenges, labor, the pressure on the consumer. Our consumer is brand loyal. We have an outstanding brand, but they too have been punished coming through this inflationary time. So, all those cost pressures, obviously related to our business, put the pressure on us to lead us to where we are today.
And so now, Sal, the plan is a group that includes the founders, buys the company-owned restaurants?
Absolutely. It's a super exciting day for the brand here, right? And that's exactly the headline. We've got two large operators, the most successful ones in the entire system. One of them happens to be the original founders of the group out of Clearwater, Florida. 42 years of experience, operating 15 out of the top 30 restaurants around the globe. So we could not be more excited for our customers. We could not be more excited for our employees that this group is coming in. And who better than the founders of the concept to take this brand and return it back to where it was.
And Sal, are you all detailing what the purchase price was?
We're working on those details now. We have entered into a restructuring support agreement. We're actually heading into first day motions tomorrow in the Northern District of Texas, hoping to get some approval on some DIP financing. We've got $35 million of new incremental capital coming in, and that'll provide the liquidity and the runway that we need to then effectuate this plan.
And so give us a sense of how big the Hooters footprint is right now in April 2025. I mean, how many locations, Sal, across the country?
Yeah, great. We have a little over 300 today as we sit here. We operate in 22 states. We've got 151 corporate-owned stores. We've got about 154 international stores, and we operate in about 17 different countries around the globe.
And the plan, Sal, to reiterate, is those locations stay open?
Absolutely. We are open for business, especially depending where your bracket is. We're in the middle of March Madness, so we are open for business. People are excited. Business as usual at a store level. Our brand loyal customers are ready and they're engaged. And we're really heading into baseball season, the Masters. So yeah, we're business as normal and in full swing.
So this buyers group that steps in now, Sal, what's their plan for Hooters? What's their plan for the brand, for the locations? How does it change, if at all?
Yeah, it's a great opportunity, right? We're talking about the folks that started this concept, that have made it what it is today. So from a brand perspective, there's going to be reinvestment in the units. You're going to see a return to original food items. You're going to see the world-class famous Hooter girl that has been on a pedestal for 42 years being showcased and featured. There'll be investments in the units. There'll be investment in marketing. So I think you're going to see a complete renaissance. We like to say it's the rising of the owl here coming out of the ashes. So we're super excited as a brand. Our consumers and employees could not be happier.
I was reading, Sal, the New York Times talked about this, obviously, and they talked about a rebrand that would give Hooters a more, as they put it, wholesome image. What does that mean exactly, Sal?
Yeah, look, I mean, Hooters has always prided itself on being a neighborhood restaurant, right? We're a tremendous complement to the sporting industry. And when you look around the globe, you do see in different parts of our business where, we have women, we have children, we have families, we have retirees that play golf and have dinner because they got to be in bed early, right? So we've got a great customer mix. And I think by returning to those roots, it's going to really enable us to launch the business, put it back in the hands of the original founders and some of the top operators in the system. And who better than them to launch the business forward?
Sal, who's the Hooters demo right now? Who's your average customer? Give me the profile. And has that evolved at all over time, Sal?
Yeah, it has evolved. That's a great question. I mean, if you think back 43 years ago, traditionally it was the World War II baby boomer and that generation. But then there's the next generation that grew up there, coming to Hooters with their dad. We see retirees. We do a Wings for Children program around education in the city of Chicago. We see teachers. We see firefighters. We see first responders. So we really are a great cross section of America. And I think that's going to continue and it's going to be accelerated under the new ownership.
And Sal, you were mentioning how many locations you have across the country. I'm just curious, are there certain regions or states, Sal, certain locations that tend to kind of perform better than others?
Yeah, good question. We started in Florida, and a lot of our footprint is in the Southeast. Yet, ironically, Chicago, for example, has some of the top performing stores in our system. We've got units that do, $6, $7, $8 million a unit selling just chicken wings and beer. So it really comes down to store execution. It's all about the brand, the way that brand is portrayed. I learned a long time ago, it's not what you think about a brand. It's how you feel when you interact with it. And that's our job to return it to the glory. And I think this new ownership is absolutely going to deliver on that.
Sal, great to have you on the show today, sir. Thanks for your time.
Hey, thanks for having me, Josh. Good to see you.
We got breaking news here. Circle filing for its initial public offering. That company is planning to list on the New York Stock Exchange under the ticker symbol CRCL. Circle not disclosing a number of shares or the expected price range. Founder and CEO Jeremy Allaire saying in the filing that going public is a continuation of our desire to operate with the greatest transparency and accountability possible. Circle is the latest in a string of companies to file for an IPO, including, of course, Klarna, Discord, and StubHub. And the move follows CoreWeave's highly anticipated offering just last week. According to private company data on Yahoo Finance, Circle has a valuation above $5 billion. And you can head to Yahoo Finance to track more private company data, including valuations and funding rounds, by scanning the QR code below. Well, that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.